give me a description of the recovery shape?
So I'd say I'm firmly in the U-shaped camp.
It's not a W.
Where we get a W is where actually the second wave is even worse.
How will that impact your multi-assets view?
We've bought those assets that benefit from the liquidity provided by the central banks.
Do you have any concern of the future inflation?
Like when you shake a ketchup bottle and suddenly the ketchup comes out.
When the party is over, who will pay that?
Be future generations in the form of lower growth and lower returns, unfortunately.
How do you see investment opportunities in China?
We as a company have prioritized investment opportunities in China.
What are you looking for, growth or value?
Growth, actually.
Thank you, Johanna, very much for your time to join Top Investors Talk. So where am I getting you today?
From the English countryside, very green.
Very good. We've been living in this pandemic for almost 6 months, and most of the countries in the world have exited their lockdown in the first place. But we see some resurgence of the infection in Europe, let alone the United States, where the virus control has never reached a manageable level. So in terms of the fundamental economists, do you have any concern of the recovery trajectory or any double dip?
Well, I think that just based on the level of infection we've observed over the summer, we have to put quite a meaningful probability on the risk of a second wave of the virus as we move into the winter.
In your blog, you said that you are not sure the market has well prepared for this.
I think that what is potentially a risk as we head into the autumn, obviously in the last few months we've seen very significant government support measures, and some of them are going to start to be unwound as we head into the autumn. I think also some companies maybe delayed the decision to lay off workers, waiting to see what would happen with the virus. So I think what we really need to watch as we go into the autumn is whether this economic momentum can be sustained. It's very easy to get a strong bounce from very depressed levels, but actually going forward, can this economic momentum be sustained, particularly if companies start to make more medium-term decisions about the number of workers they actually need? So I think there's potentially a bit of an economic challenge in the autumn, really as the world, again, starts to think more medium-term, moves from hibernation to actually having to make some decisions about the future.
If I want you to give me a description of the recovery shape, such as a V, a W, or a U, or Nike swoosh, which will be your choice?
I think a U or Nike swoosh. I think there's evidence, there's some sectors that benefited from a V-shaped recovery, but I don't think you can make that argument for the whole economy. The number of areas that are not moving back to normality anytime soon. So I'd say I'm firmly in the U-shaped camp.
It's not a W.
With the potential of a W. I think that where we get a W is where actually the second wave is even worse. We see the same level of fatality again. So as I said, in monitoring the infection rates over the summer, we've seen similar levels of infection, but lower levels of hospitalization and death. And I think that's what we need to continue to see for us to weather the next wave without too much trouble.
How will that impact your multi-assets view?
The way that we played it in multi-asset is we've had to recognize the fact that there's been a lot of support provided by governments. And so essentially we've bought those assets that benefit from the liquidity provided by the central banks. What's driving markets at the moment is the suppression of the discount rate. So we obviously bought credit when the spreads widened in March. We've bought emerging market debt. We've owned high yield debt as well. And within equities, we tended to have a quality bias. So really trying to benefit from those lower interest rates, but at the same time, trying to avoid too much cyclical risk because we don't expect a V. So it's a quite careful balancing act between benefiting from the liquidity, but not getting too cyclically exposed. And we've sort of been traveling along that knife edge all summer.
Yeah, you're right. We see the unprecedented support from the central banks, from the government to cushion the impact of this virus. So do you have any concern of the support in terms of the cost, the accuracy, or the side effect?
I think there may be questions about sustainability over the long term, and this is where the central banks will probably have to manipulate the yield curves for years to come in order to be able to afford the debts that they've accumulated. So again, it means more manipulation in the bond markets. It's an uneasy equilibrium that I think we're going to be seeing. But I think that, in many cases, it does appear that there's a lot of coordination between the monetary and fiscal authorities with an emphasis on keeping those yields low so that we can afford the debt we've accumulated.
Actually, the question is, when the party is over, who will pay that?
Well, I think the key question is whether we'll get inflation. So if we get inflation, the central banks then don't have the luxury of keeping rates this low. If you're able to keep the rates low, I guess the debt can be gradually paid off, but it will take us many, many years. And I think essentially who will pay will be future generations in the form of lower growth and lower returns, unfortunately. Inflation helps the young, hurts the old. I think, unfortunately, we're looking like we're going down a policy which is about lower growth rates over the long term, which probably hurts the young.
That is very odd because, in the market, half of the people are worrying about the deflation and half of the people are worrying about future inflation.
Yes, I guess I'm probably more in the deflation camp. I mean, I have been in that camp for a long time, and I have to admit that, with all the stimulus the central bankers are providing, at some point I'm worried that inflation might splurge out, a bit like when you shake a ketchup bottle and suddenly the ketchup comes out. There is a risk there, right? I mean, you throw enough money at the system and eventually you might let the genie out of the bottle type thing. But I think, again, the main challenge we've faced for a number of years, partly due to demographics, is lower growth, lower demand. So I'm more worried about growth over the long term than I am about inflation.
Everyone in this planet now are hoping for the cure or maybe the vaccine of this virus. Now we see some very significant progress of this vaccine, which means that we will get it sooner rather than later. How will that impact your investment strategy?
I think the assumption that we're getting a vaccine in the next few months, which would in practice mean that people get vaccinated. It's not immediate, right? You get the discovery, confirmation the vaccine is effective. There will be a lag between that confirmation and that being distributed to everyone. But essentially, if you think about what the market's been assuming all along, was that we'd have a vaccine by the first half of next year. And by that I mean people vaccinated by the first half of next year. And so I think we're still on track for that, which is basically why the equity market to some extent is looking through this whole crisis, because the assumption was that we'd somehow get out of it by the first half of next year. So for me, if we get discovery of a vaccine, I think actually it confirms the pricing we've already seen in the equity market. You might get a bit of euphoria short term, you might see a bounce in some cyclical assets, but I think it is actually quite close to what's already priced into equities.
We see the dollar suffered the most severe monthly decline in a decade in this July. The question is, does the weakness of dollar have anything to do with the poor management of the United States virus management?
No, I don't think so. I think the dollar is weak for two reasons. First is that obviously it's benefited from having a very positive carry relative to other major currencies for the last few years. So it was a beautiful thing in the sense it was a positive carry hedge, and investors love that. The challenge, of course, this year is with rates being cut, that carry has evaporated, so you don't have the luxury of the same positive carry you had before. And on top of that, you now have a competing safe haven currency in the form of the euro. The one thing that stopped the euro from being conceived to be a safe haven was always this concern of a kind of nasty tail event with sovereign debt. With the recent coordination we've seen across Europe in terms of fiscal policy, that risk has been significantly reduced. So now you have a competitor, another currency that can offer safe haven characteristics, crucially with a current account surplus. So I think that's what's driving dollar weakness at the moment.
Do you see any major change of the global supply chain?
Well, one of the themes that we were positioned for even coming into this was automation. I remember last year, one of our stock pickers was telling us about a stock that basically they created robots that could serve in bars. And I remember thinking, why the hell would you want to go to a bar where you're served by a machine? Surely you still want to speak to a barman or something like that. But guess what? You get something like COVID happen, you can see how even that might be of interest. So I think, unfortunately, automation probably is likely to continue to be a trend that I think has been accentuated by COVID. And it does pose a headwind to employment growth in the future, which also I think means elevated political risk. So in some sense, a continuation of some of the trends we've seen in recent years.
Yes, you mentioned automation. The lockdown of the economy disrupted many supply chains. Do you think in the future the companies will sacrifice some profit in order to be more resilient?
So, as active stock pickers, we don't mind disruption because typically there will be winners and losers, of course, but we can adapt to change. And I think there might be a bit of a change on that front.
Do you have any worry about the deglobalization?
I don't worry about it. I think it potentially puts pressure on profit margins because clearly many companies have benefited from the trend towards globalization and the endless search for efficiency. there is a need for greater operational resilience. I think that could have an impact on some companies in terms of the level of profitability. But as I said, it does also create opportunities for more regional players that may be underpriced. So for me, it's a disruptive trend that actually has winners and losers, and something that we can benefit from as active investors.
So how do you see investment opportunities in China?
Well, we as a company have prioritized investment opportunities in China. It's a market also that's very interesting, even from a technological perspective. So, we mentioned that there might be a headwind for tech stocks if we get a vaccine. But I think ultimately technology is a driver of the future, and China is one of the markets that's a leader in this area.
Name some.
I won't go down to the stock level because I'll leave that to my stock picking colleagues. But I think that there is a lot of innovation in China. Compare it with Europe, where, for example, we have very few strong technology names, really, and how much can we chase the US names? So for us, China is an interesting market for that reason.
Anyway, speaking of China, what are you looking for, growth or value?
Growth, actually. So I think sometimes it's easy to try and chase value in China, but I actually think it's a growth market. That's the way we think about it. So as I said, we compare it to the US. That we don't compare it to other emerging economies.